So in today's video, we're looking at what I feel are some of the best tips and tricks to get the most out of your savings account, which includes a few things that I do myself to maximize my return. So the first thing that you can do to get the most out of your money is don't keep your savings at the same bank as your checking. And as a disclaimer, this tip is not for everyone. This is more so for people who view their savings as an extension of their checking account and they have a habit of dipping into it unnecessarily. Even though having both accounts with the same bank is extremely convenient, in most cases they will be linked in some way. You can usually use the same login information and the same ATM card for all accounts with the same bank, which means you can easily move money back and forth with just a few clicks, and sometimes these transfers can be instant. And yes, that is an ideal scenario. Most people will agree with that. But the problem is that for some people, when they know that they have their savings account linked to their checking and they have backup funds so easily accessible, there might be temptation to spend more than they actually have in their checking account. But on the other hand, if you were to keep these accounts with separate banks, what you're actually doing is creating a buffer or putting some distance between your checking and savings. And this tip isn't completely foolproof, obviously, but it can slow you down a bit, because when there's the extra step of having to transfer money from one bank to another, that gives you time to rethink the decision to dip into your savings, which can help curb some of those needless withdrawals. It's also a good idea to open more than one savings account. Some people have one savings for all of their goals because it's simple and that's their preference. However, there are benefits to having multiple accounts. I know from experience that when everything is in one pot, it can get confusing. You can easily lose track of how much you've set aside for different purposes, and if you're not careful, you might even end up spending some of your emergency fund on non-emergency expenses, such as going out of town or buying gifts. So my recommendation, which is also what I do myself, is to have a rainy day fund, which is a regular savings with a local bank or credit union that holds between $1,000 to $2,000, which gives you immediate access to cash for smaller emergencies that you can pull out day of with your ATM card. The second account you need is your actual emergency fund, which will hold 3 to 6 months of living expenses. And I suggest keeping this in a high yield savings with an online bank because you're able to earn a much higher rate compared to a regular savings. And for other goals, such as a down payment fund, a vacation fund, or maybe a new computer fund, you can create separate sinking funds accounts for these, which can also be a high yield savings. You should also name your savings accounts. And this is something that is so simple and small, yet it can be extremely motivating. Because when you give your savings account a specific name like emergency fund or vacation fund, this creates a tangible reminder of what you're saving for. And this simple adjustment will make it so much easier to stay committed to your plan, especially during those times when you're tempted to spend money on things that don't really matter. And I also love the idea of naming your savings because it really helps to keep your money organized, and it can also prevent confusion if you have multiple accounts with similar balances. Over time, you might forget which account you have earmarked for each goal, but when you attach a name to your account, you can see at a glance what you're saving for and how much you've saved. Also, choose an inconvenient bank. I've had people confirm that this tip actually does help if you're trying to reduce unnecessary ATM withdrawals, because getting to your money will take more effort. And if you don't know what I mean by an inconvenient bank, this includes one that's far away from your home or work, meaning you have to drive out of your way and make a special trip to get your money. And this also includes banks that don't have physical locations or those that have a limited number of branches or ATMs. And of course, the main downside is that you'll have to put in a little more work to get your cash. But if you're serious about saving money and hitting your financial goals, and you really haven't made a lot of headway with using a bank or credit union that's closer to where you live or work, switching to an inconvenient bank can be a strategy that pays off. In addition, you can get a high yield savings account that doesn't come with an ATM card. One thing to keep in mind about high yield savings is that these accounts do vary from bank to bank. So while some banks might include an ATM card that you can use to pull out cash on an as needed basis, others might not, which can be a positive. And the biggest pro of not having one is that you're not able to withdraw money on a whim. Instead, you would have to transfer funds from your high yield savings to an offline bank, which can take 24 to 48 hours. And some people don't like that, but this is a great feature if you're someone who has issues with impulse control, or if you have a habit of always dipping into your emergency fund for non-emergency expenses. And finally, you can get the most out of your savings account by setting up automatic transfers. And one key advantage of automating is that you're able to save money on a more consistent basis because you don't have to rely on willpower, motivation, or memory. And keep in mind too that this can also help you prioritize savings, which is a crucial component if you're trying to get better at paying yourself first. Some people do the opposite and they pay themselves last, meaning that they will pay their bills and do everything else with their money throughout the month, and only if there's something left at the end will they move it into savings. But what some people don't realize is that that's actually a backwards way to manage your money, because if you wait until the end of the month, there is a good chance that you will either not have anything left or have very little left. Paying yourself first involves treating your savings account like it's another bill and automatically transferring funds into this account before you do anything else. So that's all that I have for you guys. Don't forget to like, comment, and share, and also subscribe if you like personal finance and you want to see more videos like this. I typically post on the weekends, so thank you again for watching, and I'll see you in a few days.